Hello, welcome to Chapter 13. There's a couple of chapters that probably are more important than others in our textbook here in Intermediate. We've already had Chapter 8, which is Revenue Recognition. You had that in 3010. So important, recognition of revenue, all the performance obligations and so forth that are necessary for the accrual of revenue. So important, but second to that is Chapter 13, which has to do with the matching principle of accruing your expenses with your revenues, or a matching of your expenses with your revenue. That essentially is about 95% of what you do as accountants is in those two chapters. So as we look at Chapter 13, this is a rather long chapter. It's a simple chapter, but it's rather long and involved. But I've also got a supplemental PDF out there as well on purchase to pay or procure to pay, which is about the three-way match. And I'll talk to that as well here as soon as we get through the various PowerPoints that I find are important for us to look at. So let's look at let's see here if I can find it, share the actual there it is. Hopefully you can see that. What we're going to look at here is these PowerPoints. There's a lot of them, but we're going to look at the most important ones. Operating liabilities and contingencies, Chapter 13. Operating liabilities, because these are less than 1 year. You know, current assets are assets that you can turn to cash in 12 months or less. The operating cycle, which operating cycle is 12 months or 1 year. Here we're looking at operating liabilities or current liabilities and contingencies, meaning, well, this may be a liability, it may not be, because the essence of this chapter is about debiting expense, crediting the liability. Debiting expense, crediting the liability. All right, so 4 learning goals here. The first one is a sort of a catch-all for everything from accounts payable to trade notes payable. We'll learn more about notes payable in Chapter 14. Unearned revenues, you've already touched on in Chapter 8. When you receive cash for something that you haven't earned yet, it is a liability. Gift cards. What about a deposit? Sales tax payable. Compensated absences, things like vacation. All these are your current liabilities, what you expect to have to fork over cash for in the coming 12 months. There's also a section here on asset retirement obligations, ARO. If you work in a toxic environment for a company, and a lot of those are around, whether it's a nuclear fuel in Irwin or Eastman Chemical or Exide, all of these that deal with toxic materials, you'd have to account for that as an obligation of cleaning that up at the end of the asset's useful life. Good exercise in Pearson on that as well. And also number 3 here, describe the accounting for gain and loss contingencies. And how do we determine, do we make an entry, do we disclose it, or do we do nothing? A lot of good stuff in this chapter. And then fourthly here, demonstrate the accounting for common loss contingency, talking about litigation, possible lawsuits, warranties, and premiums. Probably not going to talk about premiums much. It's really about litigation and warranties. Trying to pick out the most important parts because there's a lot here. All right, operating liabilities. Again, this is what you're going to pay cash for in the next 12 months. So we have a whole slew of those. I just went through that list, so we'll just keep going here. Accounts payable, you know, very basic. You learned in 2010. You debit expense, you credit accounts payable. And then once you actually make the payment, accounts payable is debited, zeroed out, and it comes out of cash, right? Very simple. That's what accounts payable is. Trade notes payable. Notes payable in and of itself is typically long-term, although the current portion of that is short-term. But here, trade notes payable is something that's accounts payable that maybe is not paid in 30 days, which is typically when, well, most companies will require is that bills are paid within 30 days, not always, but oftentimes. And if it gets beyond 60 days or so, there may be interest associated with that. If there's interest associated with a payable, then it becomes a trade notes payable. A very simple example there, buying inventory, crediting accounts payable. So you see the process there of debiting expense, crediting payable. Although in this particular situation, you're buying something that is inventory, from cost accounting or managerial accounting. You're putting it into inventory, work in process, raw materials, all those inventory accounts, or finished goods, purchase parts as an asset before it's actually expensed. Trade notes payable as well. Not going to spend much time on that. Very straightforward how you book the notes payable, right? Much like accounts payable. And then you have interest expense that accrues to that. Accounts payable, there's no interest involved unless you don't pay your bills on time, then you get assessed a penalty and maybe interest. All right, what about unearned revenues? Very common for a company to receive revenue, but it's not earned yet. A good example of that would be maybe you got race tickets at Bristol Speedway. Of course, it's not like it used to be when as soon as the race was over, you would get billed the next week. I know I had 6 tickets for years, and I would get billed the week after the race, like the spring race, to pay for next spring. And I would have to pay that bill, that invoice, within just a few weeks. Well, that cash that Bristol Speedway or Speedway Motorsports would receive, they would obviously debit cash to go into their account, but they would credit unearned revenue, which is a liability. Now, you hear unearned revenue is a liability. Well, that's because they've got cash, but they haven't earned it yet. And the accrual basis of accounting, going back to Chapter 8, you have to make sure you put that on your books and record the revenue when it is earned. Now, next year, if you were paying that here in the spring, next year when the race is actually held, as soon as that race is over, the performance obligation is met, then that would be debited to unearned revenue and credited to the sales revenue, right? Very straightforward. So that's what unearned revenue is. You have to recognize the revenue in the year in which it's earned. That applies to magazine subscriptions. If you're a company that maybe gives you the opportunity to have a 5-year membership or 5-year subscription to something, and you have to pay 5 years to get the discount, then they only recognize one of those 5 years each year as they meet their performance obligations for that subscription or that membership. Very similar. And so there's an entry: debit cash, credit unearned revenue, whether it's tickets, subscriptions, memberships, whatever that might be. And then, of course, that unearned revenue is going to be reduced. There's a good example of unearned revenue over the life of, in this case, it's an insurance policy, right? All right, so they recognize 7 months of revenue there. What about a gift card? We've all bought or purchased gift cards in the past. Let's say you go out here to Longhorn Steakhouse and buy a $50 gift card. You give them $50 and they put that into their bank account, debit cash and credit gift card, which is really unearned revenue, very similar. And they don't recognize the revenue until you actually take that gift card and swipe it and actually use that service or partake of the food and beverage at that location or whatever location you happen to use. So this is very similar. Some of the issues you run into, because this can get really complicated with gift cards, is, well, you've already got a $50 gift card and you use $48.95, so you got $1.05 left on it. I know probably some people will keep the card and say, well, I'll use it sometime, and other people just throw it away or lose it. I mean, you could lose a card that had $50 on it. That happens. So what happens is this stand out there or stay out there forever on your books as unearned revenue? And the answer is that you really have an aging report that you can generate out of your financial system that will tell you how old is the gift card. And after a certain amount of time, you can take that, and as they call it here, breakage, right? They can take that breakage and actually make an entry to take that out of unearned. In this book, it has sales revenue from unutilized gift cards. Long account title was something to isolate that this revenue came from something that is old. All right, so again, there's a journal entry for debit cash, credit, unearned revenue, gift cards. the use of the unearned or use of the gift cards, $30,000. They also show here an example of actually recognizing the cost of goods sold, comes out of inventory, goes to cost of goods sold, goes from your balance sheet to your income statement. And of course, the difference there between sales revenue and cost of goods sold is what? That's your gross margin. So that's your income. All right, we'll skip through this breakage part. Let's look at deposits. What's a deposit? When I was at Exide, we actually filed Chapter 11 back in 2002. And when Exide did that, our corporation, it was through no fault of anything going on locally. When you file Chapter 11 reorganization, you have protection against creditors coming back into your facility and taking anything that you've got custody of, whether you paid for it or not. And when we did that, our electricity, we owed $250,000 for the latest electricity bill, but we also owed $150,000 in a long-term contract with a subsidiary of Exide in Bristol. So in essence, $400,000 was how much Bristol, Tennessee Electric lost from this Chapter 11 reorganization. Because of that, the municipality code in Tennessee allows for companies like BTES, which is Bristol, Tennessee Essential Services, not electric, but essential services, which includes electric and cable. They're allowed to require a deposit going forward. Admis Energy, who we bought natural gas from as well, they were allowed to have a deposit on hand as well. Of course, this was in, what time of year was this? I think it was in May of 2002. That was the time of year when we didn't use that much natural gas. I think the deposit was maybe $40,000, but the deposit for Bristol, Tennessee Essential Services was calculated to be $1 million. So Exide had to write a check for $1 million. Of course, this was funding from creditors who, once the company's reorganized, the debtors, the stockholders pretty much are broke, lose everything, and all the debt holders are the ones who take over the company, and they ante up additional dollars and gave that to $1 million check to Bristol, Tennessee Essential Services. Now, what entry does Bristol, Tennessee Essential Services put on their books? But that's really what we're talking about here. So let me see if I can pull that up. Notepad here. All right. So Bristol, Tennessee Essential Services, which I'll probably up at BTES, they received cash of $1 million, right? 1 million. Their credit was to what? Deposit. That's a what? That's a liability. Of course, they just, very simple, they just sat on that for years until they had to actually pay it back, which was, I don't know, 7 or 8 years later, but they paid it back. Of course, then they credited cash and debited the deposit or the liability. Of course, every month we continue to pay them, even though they had the $1 million, we continue to pay them whatever our bills were and so forth. But on Exide's books, at the same time, this kind of going back to what you did in 3010, at the same time, we credited cash for $1 million, right? I always like to look at both sides, both companies. What would Exide's debit have been? Remember the advance or advances? That's an asset. So Exide on our books had an asset that where you just took it out of cash and put it to advance, meaning we expected to get that back at some point. If we filed Chapter 11 again or didn't come out of Chapter 11, then that $1 million would, whatever part of that was based on, not the $400,000 because it's gone. You have protection against that. But any future amounts that Exide may default on, BTES would be allowed to take that. But in essence, without spending a lot of time on this, that's what your journal entry would look like. Let me go back to the PowerPoint now. You can read a lot of this for yourself. I mean, I don't want to make this into a 2 or 3 hour video. There's deposit liability. I just call it deposit. We got a good exercise in Pearson as well on that. A lot of exercise. I think there's about 13. I may have to make 2 videos of the homework. Sales tax payable. Sometimes wish we had a class here at ETSU in accounting that did nothing but cover sales tax rules and regulations. Because in Tennessee, that's the big one. There's no state income tax. The Halls tax is going away, which is intended for unearned income. This is the last year of that. You have franchise and excise. But the big driver of revenue in the state of Tennessee is sales tax. You probably know that from going to the stores where you're paying 7% state and you're paying, well, in Bristol, 2.25%, city or local. Kingsport, I believe, is 2.5%. I believe Johnson City is 2.75%. But that's 7%. That's a lot of money that's going to the state. Well, there's a lot of rules and regulations on sales tax. You can become a sales tax guru just from all the regulations that are out there. It's very complicated as well. I mean, you can get an industrial machinery exemption for any equipment that you buy that is actually making product and manufacturing. That's 100% exempt. So you pay no sales tax on a piece of equipment that you buy in a business to make product. Anything associated with quality assurance, environmental, all those things are tax-free from a sales tax standpoint, state and local. It gets a little more complicated when you start talking about things like, well, let's take gloves, for example. We used to spend tens of thousands of dollars on gloves every month at Exide with 1,000 employees. You can imagine how many gloves people went through on a daily basis. Well, here's the interesting part. If you're working on a production line, those gloves are non-taxable because they are, even though you're using equipment, there are situations where you're touching the product. Anything that touches the product is tax-free. But if you're working in the maintenance department or if you're working on the docks as a fork truck driver or receiving, all of those gloves are 100% taxable at 9 and whatever percentage, 9.25 or 9, I guess it was 9.25% in Bristol. Very interesting. You start talking about environmental, all your dust collectors or bag houses, all your duct work, anything for the general environment is non-taxable. But if you have like an eye wash station for employees, in case they get acid in their eyes or something, those, or breathing apparatuses like a mask, and these masks are a lot more complicated than what we see in the public today. These are respirators that go on a person's face. Those respirators are taxable, even though it's for the environment, it's for the employee. But for the environment in general, it's non-taxable. Before personal protective devices like PPE is considered taxable. PPE, that's a very common term, right? Personal equipment that you wear for your safety or eye wash day, all of that is taxable. Go back to gloves that they wear on a production line. The outer glove is non-taxable, but the inner liner, like a lot of people would wear an inner liner inside the glove, the inner liners are taxable because they didn't actually touch the product. It gets very complicated, and I'll give you one more example. Fork trucks, forklifts. We had a lot of them, maybe 40 of these fork trucks throughout our facility that moved product around. And moving this product around, the state sales tax law said that if these fork trucks moved 51% of the time, if these fork trucks were used 51% of the time to move work in process, then they were non-taxable. But if they were used for raw material or finished goods, right, beginning and the end, if they were used 51% of the time for that, then these fork trucks are taxable. That sounds almost crazy, doesn't it? So you have to make that determination of what the use is for things like that. So the sales tax laws, and I guarantee you, it's not a question of if I'm audited by Tennessee Department of Revenue, it's a question of when will I be audited. I was audited at Nuclear Fuel multiple times, Exide, I wasn't at Lear long enough, but all these places are going to audit for that because it's their source of income. The sales tax payable, the essence of what's in this chapter for the exam is just about debiting sales tax expense, crediting sales tax payable, or whatever the debit might be. It's not necessarily expense, right? It's probably, well, let's just see if they've got one here. There it is. So you're receiving I'll take that back. It's not expense. You're collecting the cash from selling something, and you've got to take that cash and remit that. So it's not an expense. So you're debiting cash or accounts receivable, and the credit is to sales tax payable. It's not a part of sales. And then once you actually fill out your monthly form that you remit to the state, then you're going to debit sales tax payable and credit cash. So you're just holding that cash until you actually have to pay it back to the state or remit it to the state. Income tax payable, we have a whole chapter on income tax. I know you're looking forward to that, but it's not like you think. So don't get worried about it yet. But income tax payable, again, is when you've got a debit to income tax expense, credit to income tax payable. But income tax expense is what? That is GAAP, right? Chapter 13, matching of expense with revenue, right? Income tax expense debit, credit to income tax payable. Income tax payable is to the IRS. GAAP, expense, IRS. Those two don't always match, do they? If you've had income tax, you know MACRS, Modified Accelerated Cost Recovery System, accelerated depreciation. You might use straight line for GAAP and MACRS for income tax. Well, those income tax expense is not going to match income tax payable, is it? And that's when we get into something called deferred tax situation. We'll talk more about that in a later chapter. This is all about debiting income tax expense, crediting income tax payable as if they're the same amount. But you do have those timing differences that we'll talk about in chapter 17. Talk about that later, which I think that is on chapter 17, which will be exam 3. All right, what about compensated absences? If you work for a company long enough to have, or for a company that actually has benefits like vacation, when you earn that vacation, you are entitled to receive payment for that, either in time off with pay, or if you get terminated for whatever reason, you are entitled to be paid for vacation that has been earned. So that is a compensated absence. Here they like to talk about several of these situations. Vacation is the main one. Illness, you may be paid for time off for an illness, but you don't typically accrue your liability for that. Because if you leave a company, most companies, not all, but the majority of companies, sick time is just there as an employee if you get sick. If you leave the company, they're not going to pay you for unused sick time. If you work for the state, they may extend your service period for your pension, but they're not going to pay you for your sick time. Now, there's some companies that might, but they're few and far between. But vacation, about every company pays vacation if you get terminated, whether wrongfully terminated or rightfully terminated. You get paid for your vacation. Holidays is another one that you get paid time off for holidays, but you don't make an accrual for that because the holiday, once the holiday occurs, then you're paid for it, right? It's not like you've got vacation that you've earned on January 1 and you've got 12 months to take it, or maybe you get to extend it to future years. You have to accrue that liability of paying that vacation out. It's not like that with holidays. It's not like that with an illness. Military service, if you get time off for military, you don't accrue that. You just pay the time off when it actually occurs. Jury duty, the same way. Maybe you pay the difference between what you get for jury duty pay and what you would have made on the job. You don't accrue that. You just pay it as it occurs. And maternity leave as well. FMLA is one of those where you just get time off. You don't get paid time off unless some companies have changed that to where they want that as a benefit for families. But FMLA is usually time off without, FMLA is actually time off without pay. But the only one here that really jumps off the page is vacation. And our first Excel assignment is going to be about accruing vacation. And you can read about that and listen to and watch the video associated with vacation, which is at the end of this module. All right, so a key term they like to use there is called obligation. See that right there? Obligation. Remember that. A liability is an obligation, or I guess I ought to say an obligation is a liability. You are obligated. If someone has earned vacation as of a date to take at some future time, you're obligated to pay that. So you've got to set up the liability. You may be obligated for these other illness, holidays, military service, jury duty, and if you're paying maternity leave, you may say you got a policy, you don't pay that if it happens, but you're not obligated to pay that in the future. They have to actually work to that point, right? You've earned a vacation as of January 1, as of that day, even though you haven't taken it. That's the difference. All right, so you're obligated. What did I just click on up here? All right, just click the video off, which you may like that, but all right. Accumulated benefits, vested, accumulated. So you vest whenever you actually have satisfied a certain period. Don't worry about that. Current versus estimated future compensation rates. I'll talk about that in the Excel assignment. Accrual of sick days, I've got there in red, that is rarely used. Rarely accrued. You just don't accrue sick days. You may accrue it for extending your service, meaning if I've accrued 3 months of sick pay working for the state for a number of years, and I retire after 20 years, I can retire after 20 years and take that sick time that I've accrued. I'm not going to get paid for it, but I can extend my work time from 20 years to 20 years and 3 months, which is probably going to increase my benefit. But I'm not going to accrue it from the standpoint of a obligation that I have to actually make an entry to expense, like vacation expense and credit vacation payable. I'm going to skip these exercises because we'll look at those in Pearson. I would encourage you to look at these. I just don't have time to go through 130 slides in a video. Offers. You know what I was about to say on that prior slide, when you make a journal entry for your vacation accrual on let's say January 1, what if you're going to give a wage increase mid-year, like June 30th or July 1 or April 1? April 1 is going to be the one we do in the Excel assignment. GAAP or FASB says you can't make an accrual based on a future wage increase. IPER says otherwise. You can make an accrual based on what you expect to pay in the future. If the company can estimate future compensation rates, it will record the liability expense based on the future rates. The difference can result in a higher liability under IPERs than under GAAP when a current estimate is used. Very interesting. IPERs and GAAP are at odds in a lot of things. And I'll talk about those as we go through this semester. But no disclosures. I don't talk a lot about disclosures in this class. Just about everything has to be disclosed. Most of the information that you learn about a company is not the financial statements, it's the disclosures, all the notes that are in there. This, for example, is talking about the accrued and other current liabilities. You know, they're outlining gift card liabilities, dividends payable, tax payables, wages and benefits. I don't see vacation. It must be included up there, wages and benefits. It's there, I don't see it. All right. So that's learning objective 1. Learning objective 2 is about asset retirement obligation. Now, what on earth is that? That scares people when they hear that, but don't make it more complicated than it really is, because it's not. All you're trying to do with an asset retirement obligation is, if I'm going to spend X amount of dollars on a piece of equipment or a building to be used for 10 years or 20 years, and I know at the end of that time, because I'm using toxic materials, that I can't just walk away from that at the end. I have to decommission it or dismantle it and maybe bury it somewhere in an approved location. I have to account for that future cost, which is 10, 20 years down the road. That's what we're trying to do here. You're not only spending money up front on the asset that you're going to depreciate, right? But you're also actually setting up an asset and a liability with that asset for the amount, for the present value of the amount that I expect to spend at the end of that 10 years or whatever the time period is. And at the same time, that asset liability model that I've got set up there for the retirement obligation. I'm depreciating on an asset I haven't even spent any money on yet. That's what really gets in people's head. But you're trying to get that asset down to zero. Well, you will get it to zero. You're depreciating the actual asset itself, but you're depreciating the asset associated with the money you're going to spend 10 years down the road. When it's all said and done, after all your assets are depreciated, what's left? Your obligation. It's ARO, asset retirement obligation, your liability. So your liability is sitting there, and of course it's been increased because if it's present value now, it's been stepped up through the effective rate of interest method. It's been stepped up through interest expense every year or every month until the end. So that obligation, that liability should be the amount of the money or the cash that you're going to spend at the end, if you had somebody give you a good estimate for that, right? And whether you have under accrued or over accrued determines whether or not you got a gain or a loss. So it's really not that complicated. This is probably something you're going to run into if you work at an Eastman or if you work at an Exide or BAE Systems or an Exide. All these places that have toxic material, you can't just walk away from things like that, like they did back in the 60s and 50s. Used to be they just leave that stuff there, but not anymore. You know, I talked about that obligation that's out there, that liability. You know, your assets are being depreciated. Your liability is going up from present value up to the full amount you expect to pay at the end of 10 years. Well, how does it go up? Well, you debit accretion expense. That's what it's called, accretion expense, right? To increase the value. So accretion expense is the debit, the credit is the asset retirement obligation. You're debiting expense, you're crediting liability. You're increasing that liability from present value to future value. That's all you're doing. Right, here's a great example. Fuel Co. built a gas station, underground tanks. Very common. Most of you all don't remember the mom and pop service stations. There may be a few left somewhere, I don't know, I doubt it. But they changed, EPA changed the laws years ago to where these tanks, because they were fearful of the leaks that would come out of these tanks into the ground, right, into the groundwater. So they came up with, you have to put these tanks in the ground where you can walk around and see if they're actually leaking. It wasn't good enough just to take this long pole and stick down in your gas tanks and see how much is in there to see if you're leaking, because obviously the pump, you know how much people are buying through the pump. You can compare that with how much is in your tank based on your records. And if you measure it, you can find out if you're leaking or not. Well, now those tanks have to be ripped out and put in these new tanks that you're able to walk around underground and see those. That's why you see places like Roadrunners, Pilot J, Marathon, all these places. They're not mom and pops anymore. These are huge companies that can afford to spend that kind of money to make sure these tanks are in compliance. So that's what they're talking about. They're going to put these tanks in the ground for $500,000, and they estimate after 15 years to take these tanks out is going to cost $75,000. And so they're going to use a 10% discount rate, which is really high considering the 10-year treasury rate right now is like 0.6%. It's less than 1%. So these discount rates are really out of sorts. But that's what you would use to discount that future payment based on the current rate. All right. They put all this information in one thing. So you got 10 years worth or 15 years of information, because after the end of this 15 years, that present value of 75,000 is now back up to 75, and it actually cost 77,000. So you got a $2,000 loss, don't you? Because you didn't do a very good job. Well, actually you did a great job. If you only missed it by $2,000, believe me, that's great compared to what some of you will see. So there's the present value at 10%. And the present value of $75,000 at 10% for 15 years says that I'm going to put this liability on my books at $17,954. Doesn't sound like much, right? But if you take $17,954 and multiply by 1.1 15 times, you're going to have what? $75,000. So over time, that $17,954, and right there is the asset retirement obligation, right? T account, it's going to be right there, just like that. ARO, every month or every year, well, they do it by year. In reality, you do stuff by the month. You're going to increase that ARO from $17,954 every month by 10% times the outstanding balance of the ARO. So as time goes on, and that debit is going to be to accretion expense, and the credit is going to be to your ARO, right? All right, so there's my gas station, 517,954. Gas station, that's the actual construction, the 500,000 plus the 17,954 that I haven't spent money on. Because see, I only spent $500,000. The rest of this is just stuff you're putting on the books as accountants to account for this future obligation that I have. Erase all these off. I don't know if you can see it or not, but I can. All right, so there's my depreciation expense for 15 years. There's my accretion expense. So 17,954, right? 17,954 times 10% is $1,795. Very simple. So my asset retirement obligation has gone up by 17,995, and I've got accretion expense going to my income statement. All right, so now I've got a new ARO balance, don't I? 19,749. So the next year, what's my accretion expense? 19,749 times 10%, which is 19,750, 1975. That's going to be my accretion expense tonight. So it changes every year. That's why it's called the effective rate of interest method, not straight line. All right, now they fast forward to the end. And into the 15th year, gas station accumulated depreciation is gone. You're done with it. You're fully depreciated. So you want to zero out your accumulated depreciation. You want to zero out your actual gas station. My asset retirement obligation is now up to $75,000 after all those entries down the right side, right? I forgot what it was the next year. Was it 1675 or something? It wasn't 1675. Whatever it is, you had 10 of those. So at the end of the 15 years, $75,000. So to get rid of that 75, we got a debit, right? The arrow, and now we're going to pay cash $77,000 out to whoever's decommissioning and tearing out these. Could be the same people who built it, same company that built it. You're going to pay them $77,000. Well, it's out of balance. So that $2,000 is actually a loss on settlement of the asset retirement obligation. See how easy that is? Obligation. All right, obligation. That's what this chapter is about, obligations. All right, now we're down to gain and loss contingencies. Contingencies. What about a gain contingencies? Let's start with the easy one first. A gain contingency kind of goes along with what you had in Chapter 8 with revenue recognition. You never record, and I say record, that's a journal entry. When you make a journal entry, you're impacting your financial statements. You never record a gain contingency. And I've got in red there, firms typically only disclose contingent gains in the footnotes when there is a high certainty of realization. So you're just putting that in your footnotes that, yeah, we got a high probability. Don't ask me what that percentage is because GAAP is notorious for not giving you percentages like IFRS does. But if there's a high degree of certainty, you just disclose, you just tell them about it in the story about your company. But you make no journal entry, ever. Never make a journal entry for a gain contingency. Have I said that enough? All right, what about a loss contingency? Here's where it gets to be a gray area because there's really three ways that you want to recognize, potentially recognize a loss contingency. And they give you several examples here of things that could occur like litigation, you know, like a lawsuit, environmental issues, insurance, investigate, warranties, all these things, loss contingencies are things you got to consider. All right, the three areas that you want to remember is if it's probable, you want to make a journal entry, right? I don't know why they put it in this order, but secondly, if it's reasonably possible, you don't want to make a journal entry, but you want to disclose that. And if it's remote, you don't do anything, right? So that's the levels. Probable, make a journal entry if you have a good estimate. Of course, you can usually come up with an estimate, but if it's probable, you need to make a journal entry for, and that's the conservatism principle, right? Going back to those 5 that I've talked about: revenue recognition, matching principle. Here's conservatism being used, right? Of course, materiality. What's the other one? Consistency. Those are the ones you're going to write about. We're talking about these as we go through the semester. So take notes for your gap paper as well as you go through here. It'll make the paper a lot easier to write, because I give you a lot of good examples. So if it's probable, we're going to make a journal entry. All right, so we're going to accrue a loss contingency. And obviously, if you accrue the contingency, you're going to disclose about it too, like what's behind this loss contingency. Why did you make a journal entry? All right. So if it's probable, and they use the term reasonably estimable, you can make a reasonable estimate, and you usually can, then you want to make a journal entry. All right, here's a good little chart there. I don't have it highlighted, but I probably should. If it's probable, and they've got it in a good order here as well. If it's probable, you're going to have a liability accrue with adequate footnote disclosure. And they have out here on the right, cannot be reasonably estimable. I don't know how often that occurs. If you've got something that's probable, you're going to come up with an estimate one way or another. All right, if it's reasonably possible, footnote disclosure only. All right, so that's what's important, those 2 columns. And if it's remote, remote means way down here. We're not going to do anything. Very important. That right there tells you. That should go through your mind when you're making journal entries. This should go through your mind when, you know, we're doing that vacation accrual. That's a contingent liability. Although it's going to happen, right? It's probable, and you can make an estimate. When we get to the 3rd Excel assignment, this is going to come into play as well. So you might want to make a note there as well on Excel assignment number 3, which is the OPEB, Other Post-Employment Benefits. This will come into play there. And I'll talk about that in the actual video as well. So we're getting to the end of the semester with that 3rd OPEB assignment, 3rd Excel assignment called OPEB, O-P-E-B. And we're going all the way back to look at what we did here in chapter 13. All right. Here's a great example. And this is under offers, but let me talk about this both with offers and with gap. What if you have something that's probable and you've got an estimate that is a range? And that happens a lot. Let me see if I can get my little notepad up here again. There it is. Let me clear the screen here. Clear page. What if I have a contingent liability like a lawsuit against my company? It's probable, right? Alpha says that's more than 51%. Yep, they don't tell you percentage, but we know it's probable. And let's say the lawsuit is for, we think, somewhere between 800,000 and 1.2 million. What does GAP say do? What amount? This kind of is an unusual answer based on conservatism principle, but what does GAP say? What should I book as pending lawsuit expense, or pending potential loss? Maybe that's a better term. Call it loss. And the credit would be to loss liability. Right? Loss is going to go to your income statement. Loss liability is on your balance sheet. So what does GAP say do? GAP says use the lower of the range. Surprised you, didn't it? What do you think offer says? If you look back at that PowerPoint, you'll know the answer. And what offer says makes a little bit more sense. Offer says take the average. Maybe you got 4 different estimates that's in that range. If none are more likely than the others, then they say take the average. So with offers, it's going to be what? 1 million. That's halfway between, yeah, $1 million. Offers, I was supposed to say offers and gap. 2 different ways for the same thing. Nothing's ever really clear in accounting. Have you figured that out yet? That's life. But that's what that slide is about. Estimate and range for offers. I'm trying to make this stuff, there's a lot in this chapter, I'm trying to make it as succinct and as relevant for you as possible, because 33 years, I've seen just about everything at least once, maybe twice, and some of this too many times. And there's a slide for that I do have highlighted. But I'm not going to ask you on the exam to explain the difference there. You just need to know. That's very important that you know about it. If it's probable and you can estimate it, you got to make a journal entry and disclose it. If it's reasonably possible, no journal entry, but you disclose it. If it's remote, do nothing. That's very important. You got to remember that. And you want to be consistent, because when you start making these entries, these accruals based on something that's an estimate, you've got to be consistent with that. You got to be consistent. You got to be conservative, right? That's what your accounting firm, your CPA firm is going to do. Whether you're the CPA doing the audit or you're the one that's having the audit done too, you got to make sure you're following your consistently what your, not just your accounting principles, but your interpretation of how do I do these estimates. This last part is very similar to what we had in part 3. I'm not sure why they break this out. So again, they talk about being probable and can reasonably estimate. 55% likelihood. I highlighted that because I don't know if this has to do with offers. The screen share won't let me see that. But that's usually considered probable, even though GAAP doesn't give you a percentage like offers does. All right, warranties, very important part of this chapter. Didn't really have warranties at nuclear fuel. We had warranties at Exide since we manufactured batteries. And if you ever bought an automotive battery or a marine battery or a golf cart battery or a garden tractor battery, all of those have warranties. You know, you go to the shelf there at Walmart or AutoZone or wherever you might be, and you say, do I want one with a 1-year warranty, 2, 3, 4, 5, and so forth, and each one's like $5 difference, right? I would encourage you to get the one that's got the longest warranty, because it's probably not going to last that long. But again, that is an assurance type warranty. When you're buying something in a store that already has a warranty associated with it, whether it's a 90-day warranty or 1 year or whatever, you are purchasing an assurance type warranty. And that is a contingent liability, because empirical evidence in companies, they are going to know based on the past how many of these units, batteries, widgets, whatever it might be, are going to be brought back for either replacement from inventory or from cash, right? Reduction of asset. Of course, a Walmart or Advance, they're just going to turn around and go back to whoever gave it to them or sold it to them, whether it's an Exide or Johnson Controls. But that is an assurance type warranty that you have to book the expense in the year, in the period in which the battery was sold. Even though you don't know if that battery is going to fail or not, a percentage of that. And so if you're running with 2% historical average for warranty costs or warranty expense, it's between expense and cost, right? Cost is an unexpired expense or an asset is an unexpired cost. And when that asset expires, what? It becomes expense, right? That's why assets and expenses both have a debit balance, right? So here we're recognizing an expense to go along, right? Matching that with the revenue when it is sold. And so if you sell $100,000 worth of batteries in a month and 2% of that you know is going to come back, you've got to record $2,000 of that sales revenue as warranty expense, debit, warranty accrual, credit, which is a liability. That's an assurance type warranty. What's a service type warranty? That's what happens when you're checking out at Walmart, Lowe's, whatever. I bought a gas hedge trimmer here last week at Lowe's, and it was $209. And when I'm checking out, they said, you want extended warranty for, it's usually 10%. So I think it was $20.90 or something, or maybe it's $19.99 to make it sound like a good idea. To extend your, what has a 2-year limited warranty. And of course, I always decline those type warranties, but that is a service type warranty. That is a moneymaker for retailers like Walmart, Lowe's. I bought a $20 Timex watch, I don't know, 10, 15 years ago, a $20 Timex watch. And I'm checking out, and they said, sir, do you want an extended warranty on this for $1.99, which was 10% of the $19.99, right? Of course, I said no, but those are service type warranties meant to make a lot of money for your retailers. But as accountants, we have to record those. And that is completely separate from an assurance type warranty, right? I will tell you one thing. Next time I buy a window air conditioner, I've got central heat and air, but my mom has window air conditioners, long story. But those things don't last long. And that's probably one area you probably ought to buy an extended warranty is a window air conditioner. There's probably others, but by and large, most things that you're buying, don't waste your money on stuff like that. That's free. You don't have to, it has nothing to do with accounting. That's just my personal perspective. All right, accounting for warranty costs. Assurance type, and I'm more concerned here about assurance type warranties since it's so common, but we have to do the accrual base. You know, we got to accrue that expense for the warranty in the year in which it was sold, with the expectation based on historical empirical evidence that those percentages are accurate. Now, it turns out the warranty expense turns out to be higher, the returns are higher than what we've been accruing, then you're going to have to record that expense that year. You don't go back and reopen your books. You just record that expense because that's a change in estimate. Got a whole chapter we're going to talk about change in estimates. Change in estimate and going forward. So the accrual basis is what we have to use, not cash basis. The cash basis is a lot easier, isn't it? And so we've got some good exercises in Pearson we'll look at as well. That's why I don't spend that much time looking at these exercises in the PowerPoint. You can see that for yourself. There you can see pretty straightforward. How do you make a sales entry? And then the warranty expenses associated with those units that more than likely that's what $160,000 is going to come back over the following, what they say, 2 years. 4%, 2 years after the date of sale. So it's $160,000 what they expect to actually be returned over the next 2 years. The warranty liability is set up for $160,000. That's my estimate. Warranty liability. And then what's the credit? 56. That's actual. That's actual cost associated, actual expense associated with these returns. And so over time, that 160 may be too much, it may be too little. All right. Very similar. Here's the next year. I guess that looked like the same thing. Service type, I'm going to skip that. Like I said, the assurance type is what I want to focus on in this class. Good point there, warranty accounting and practice. I mean, everybody wants a long warranty that if something fails, you can take it back. You don't have to be nickel and dime to death to buy that additional assurance. There's disclosures. Accounting for premiums. I'm going to skip that as well. It's not that common. Probably end up in a place that actually does this, but you can read that for yourself. But I don't have any exercises in Pearson assigned. And if I don't assign exercises in Pearson, you'll find that I don't test on that. My tests are pretty straightforward. If you understand the homework, you should do pretty well. Again, here in part 4, they sort of reiterate what's in part 3 about something being reasonably possible. And when it's reasonably possible, then what? We just disclose. We don't make a journal entry. It's got to be probable if we make a journal entry. When the probability of occurrence of a gain contingency is nearly certain, you disclose a gain contingency. You never make a journal entry for a gain contingency. I think I've said that enough times, haven't I? All right, I think that is it for this chapter. Payroll taxes. Forgot about that because I do have exercises in Pearson for payroll tax. Payroll tax is important. I know we don't talk about it in principles. We probably should. One of your first jobs may be either to audit payroll or to actually perform payroll and make the journal entries for it. Very common. I mean, most of what you do is you're either paying people or you're paying your vendors. It's either payroll or accounts payable or both. My first job as a manager was I was the accounts payable and payroll manager. I had, I think, 6 or 7 people working for me in that department, among some other things. But that's where you really have to make sure you've got good controls and things are handled in a very accurate way. You sure don't want to mess around with people's pay, right? Nothing more sacred than that. Most important job you have in your building is the person who's paying people. And secondly, is paying your vendors or suppliers. But payroll is very important. A lot of taxes, Social Security, right? Unemployment taxes. Social Security, both you and the employer and the employee pay Social Security taxes. 7.65% comes out of your paycheck. At the same time, the company's going to write a check for 7.65%. So 15.3% of your pay every week, bi-weekly, monthly, is going to Social Security Administration for your future retirement. A lot of money. Unemployment taxes are paid by the employer. You as an employee never sees that. The employer pays that. Income taxes withheld, that's based on your W-4 that you fill out when you're hired by your employer. You fill that out in HR, and then they decide, that determines how much income tax is withheld, and then that is sent to, not Social Security, that's sent to the United States Treasury. And then when you file your 1040 and you get your W-2 at the end of the year that has your federal income tax withheld, then you calculate your tax, see if you get some of that back from the United States Treasury. But we as accountants have to account for all of this stuff accurately. All right. So Social Security, FICA, Federal Insurance Contribution Act. Tax is 12.4. You know, I said 7.65, but that 7.65 is really 6.2 for your retirement, and the other 1.45% is for Medicare, for your health insurance when you turn 65, right? All right. So employer's going to remit that entire 12.4, but what they leave out here is the Medicare, which is probably on the next page. I think the annual rate has changed. 128,700 used to be the limit for the 6.2%. Now it's 135, maybe $135,000. So when someone's wage reaches that point, depending on how much you make, toward the latter part of the year, then it's like getting a pay raise because you don't have 6.2% coming out of your paycheck anymore. But The Medicare tax is what is unlimited. There is no cap on how much income you make in a year to have 1.45% taken out, which is 2.9 total, right? So here we got 6.2 and 1.45, Social Security, Medicare, what is that, 7.65 times 2 is equal to 15.3% total. But this comes out of both what? Employee and employer. Same amount, that's why it's 15.3%. Unemployment. Again, this is something you don't have to worry about as an employee, but as an employer and you being an accountant for the employer, unemployment. This is typically, I know they talk about federal unemployment, but you're paid unemployment if you're laid off, like a lot of people are right now. You are paid from the state. The state pays you. You file with the state that you are living in. And whoever actually laid you off are the ones that are going to have their unemployment rate raised. When we had that layoff we had a layoff in 2008 or 9. We laid off, we went from 810 people down to 245. We laid off like 553 people. Our unemployment rate was really low because it's only on the first $7,000 that someone makes, and it's typically like 0.8%. So that's like $56 a year. But after the layoff, our unemployment rate went from 0.8% up to like 14%. So 14% on 7,000 is what? $980? Yeah, because who's going to pay for that? The state, yeah, they're paying all these people who file for unemployment. How's that funded? Well, it's funded from the company that laid them off. It's going to take a long time to get that back to where they can really replenish their coffers with that, but it's the state that pays that. But we have to account for that as an employer tax expense. Payroll taxes payable. That's what you're going to see there as far as the liability. We got a good example in Pearson homework we can look at. I've been talking for over an hour now. I need to really end this fairly soon. Getting too long. But what you see here, and this is a good example that you can review as well. The book has it as well. It talks about federal payroll income taxes average 21%. That's really high. They just use this for simplicity. It's all based on you individually, what all your employees have filled out on their W-4 when you're hired. What you're single or married and your exemptions, although I think they've simplified it somewhat this year. State and local income taxes, Tennessee, you don't have that. Virginia, you would. North Carolina, you would. They tell you the first $7,000 is taxable from an unemployment standpoint. State unemployment rate 6%. Experience credit, meaning they haven't laid many people off, so really the unemployment rate, the tax rate is only 1%, 6 minus 5, right there. All right, so what's that look like? Well, if you can see that, that's kind of small. You probably have to pull up your PowerPoint and look at this, or PDF. But you can kind of follow through what we're trying to do. But I want to look at the journal entries, because the journal entry is really what you're trying to get to and what I would expect you to be able to do on an exam. Look at the payroll tax expense. There's always 2 entries that you're making as an accountant on payroll. 2 entries. You're making the wage expense from all your wages that people have earned, right? From wage expense all the way down to what? Cash that's being paid, take-home pay, right? And then everything in between on your, anybody's ever had a paycheck, you know, your gross wages is not equal to your net income or your net pay, right? Because I'll do it like that. Wage expense, what you actually earned versus what you were paid. And everything else is what? Is a payable to someone else. Whether it's Social Security, United States Treasury, maybe it's union dues, maybe it's health insurance, maybe it's 401k, a lot of stuff there. So there at the bottom of the page is the employer wages, right? $400,000 is your wages that you paid as expense. The cash is the take-home pay. That's what's coming out of the bank. These other payables, that's going to come out of your bank, but it's going to be paid to someone else, right? Not the employee. Maybe on the employee's behalf, but it's going to go somewhere else, not into your individual employee's account. So you got two entries, employee entry, right? That's the employee entry. And then up here, you've got what? The employer. My face is in the way. Employer entry, employer JE, journal entry, employee JE. So what's up at the top? Payroll tax expense. This is something the employer has to pay for themselves. The FICA tax payable Medicare is identical, right? It's identical. 24,008, 5,800, same here. Federal unemployment, that is an employer tax. And then state unemployment tax payable, if you have that as well. Of course, you have the state. Federal, I'm not sure why they put that there, but they do. That's the end game. That's what you're getting to every time there's a payroll run. That may just about do it for this chapter. All right, that's the end of the second month. All right, so that's it. It's rather long, but it's necessary because that is maybe the best chapter in this class for sure in 3020, and second only to chapter 8 in 3010. Because again, chapter 8, chapter 13, matching revenue recognition, so important, so important. So very straightforward though. I mean, it's not complicated. ARO is not, that's probably the toughest part of this, but think about what you're doing there with an ARO. Think about it as an accountant, accounting for a future cost and putting that on my books. So I will put another video out there as well on a PDF that I have on the three-way match, goes along with accounts payable. But sort of taking the whole accounts payable process and purchasing and really putting some wheels on something that is not in the textbook, but you need to see because this is how American business operates, whether you're a nonprofit, government, private, public, they all use these same processes for purchase to pay or procure to pay. So having said that, thank you, and we'll talk again soon.